Please stay with us. We're going to come back to you. We have a lot more queries for you. For the time being, let's welcome Newgen Software. That's the first corporate that we're speaking to today. The revenue has seen a 20% sequential rise. Margins as well have expanded by close to around 635 basis points this quarter. Remember, the company's full year revenue growth guidance is around 20% and they expect margins around 21%. Well, to focus on both these 2 points first up itself, we have Virender Jeet, the CEO of the company, who joins us. Hi, good morning, Mr. Jeet. Thanks so much for joining in. Well, your first half of the year, you have seen a revenue growth of close to around 20%. That's despite the first quarter being weak. Now, quarter four typically is very, very strong. Earlier, you guided for around 20%. Do you want to revise that number upwards? Point number one. And the second factor is on margins. That's been a little disappointing. In low teens, in the first half of the year. But you have been guiding for around 21%. You're confident you get there?
Good morning, and thank you for having me on your show. You're right, absolutely. On the growth side, I think the quarter has been much better than the previous quarter. And for the whole year, if you look at our business, is a bit sequential, and since the costs are very much front-loaded or very even, while the revenues are substantially higher in Q3, Q4, and it's a historical part of our license business. That's the nature of our business. So our margins do expand in Q3, Q4. Having said that, I think our comparison with last year margins is not the right way, because I think there's roughly around 4 to 6% of our overall revenue goes in travel, which is slowly normalizing, and that's coming back. And on this front, we are looking at a growth rate of maintaining a growth rate of around 20 or higher than 20% for this year. And the margins will be completely dependent on the kind of cost basis we are having today. This year, we did have extra costs in terms of, everybody, the whole company in the industry on the manpower front. We had to revise our, salaries and many other costs multiple times. There is going to be a cost pressure this year, but we are still sure that, with higher revenue achievements over next quarters, we should be able to, be close to our targets of the margins.
So you're saying that there is a possibility that you may not be able to meet your 21% margin target because of cost pressures?
Yeah, so I think, 21% of last year is unnatural, and we had clearly said that is not the nature of the business. We don't have, last year we had zero travel costs, a lot of other costs were not that. But we do have an historic, this business is generally a high gross margin business. We do around 65-67% gross margin business. But rest, it completely depends on investment of growth and what we spend on R&D. That determines the net margin. We are still aiming for, around 17 to 18% net margins at end of year, and roughly around 22% of EBITDA margins. Let's see how close we are to that.
Okay. In quarter one, you had missed some orders because of some delays that took place. Yeah. Can you tell us in terms of logo wins? In the pre-pandemic, you had about your logo wins were around 80. When do you plan to get back to those?
So there's a couple of things in that. We have also shifted in terms of kind of businesses we do. We are slightly going for larger deals, and some of the smaller tickets we are walking away from that because they don't have a long-term value for us. So we are targeting roughly around 50 to 60 logos here. We've done around 20 in the H1 with 14 logos this quarter. So we are on track to do that much of new logo businesses. But on, apart from new logo, I think time all deals, whether they're existing and new logos, have been substantially high. We have done major deals across our existing customers, across geos, as well as on the new logo side. So, we are quite happy with where we are on that front.
Mr. Jeet, what's the outlook on the US business? You were hopeful travel will open up, you'll win more deals as well. Though on the profitability aspect, it's still struggling. Your sense on that? Any visible slowdown?
No, on the US, there are two things. One is we are in the process of kind of resetting the US business. Again, out there, the profile of accounts on typically tier 2, tier 3 banks, which has been the business we have built over, we are slightly pivoting away from that. We are going into slightly larger accounts and resetting the organizational structure to support that out there. So it's going to take a bit more time for the higher growth to return out there. Margins, again, are a factor of growth for us. Right now, since the growth is in a single digit, low single digit, we'll not be able to deliver margins in US. So we'll give US a couple of more quarters, and then next year onwards, we think it's going to be one of the primary growth engines for us. In the meantime, we are very happy that our traditional markets have completely restored back to their growth. India, which was completely almost sleeping for 2 years, has come to a higher growth rate. Middle East and Asia Pacific are both, these both markets are very strong for us. And on that front, I think for next 2 quarters, we should be able to build higher growth. And next year, the US should be able to further substantiate that growth.
Okay, so you're saying that the Middle East and Asia Pacific markets are quite good, and next year you're looking at growth coming in from the US as well. So just wanted to understand that you're transitioning towards the annuity business more over the last 1 to 2 years, driven by cloud, SaaS, and away from license revenues. So currently your annuity revenues are about 70% of your overall business. How much do you think you can grow that to, say, over the next 1 to 2 years?
So what we are trying to do is, from the license business, we are trying to build more subscription business, which is slightly more long tail and, in terms of better control or lesser seasonality. And, slowly that business is growing, and licenses, you see the percentage of license share in our business is slightly on the decline or more flat, while the growth is happening still. On our subscription, which is purely cloud, we have grown by 50%. And if you look at on the overall annuity, we are growing at much higher than the company's growth rate. As the business starts growing organically, this percentage will keep on improving. So what you are quoting to a number of 70% is for Q1, but if you look at on an annual basis on an overall annuity business, we are roughly around 57, 58%. Up to H1, we are more like 63, 64%. I think in next couple of years, we should be able to exceed it up to 75 to 80%.
So we'll leave it there. Thank you very much for your time. Appreciate it very much here on the program.